I'm Meg Green with AM Best TV. We're in Monte Carlo for the annual Rendezvous de Septembre conference. It's a big event for the reinsurance industry, and joining us now is a panel from AM Best. Joining us, we have Carlos Wong-Fupuy. He is a Senior Director at AM Best. Greg Carter, Managing Director of Analytics-EMEA and Asia Pacific for AM Best. And Bob DeRose, Senior Director with AM Best. So could we start with what are you hearing as far as the big themes of the conference this year?
Well, I think the big theme of the conference this year is, I'm going to use the word optimism, cautious optimism. I think that, given the underlying weakness in fundamentals over a rather long period and the events of 17 and 18, I think that the broad industry is really recognizing that there is a fundamental need for improvement in pricing. I think the market, and certainly the reinsurers, and some of the alternative capital are acknowledging that the dynamics of risk have changed, I think in part due to climate change and severity of storms, and that the pricing dynamics over the past or the previous 5 years leading into 2017 really it was a long period of benign catastrophe activity, and there was a rather prolonged period of price erosion. And as a result, everyone seems to acknowledge that there is a fundamental need for improved pricing, certainly in the property catastrophe area, but I think more broadly speaking in some of the longer tail casualty classes in the U.S. And we've seen some industry leaders in the primary space, such as AIG and Lloyd's in London, acknowledge that there has been a fundamental weakness in pricing and that profitability hasn't been where it needs to be. And some of those large capacity providers are sort of leading the charge in changing the pricing dynamic going forward. So I think that that's really the broad thing. I think that there's a cautious sense of optimism, that there is a need for pricing improvement, and that is occurring. I guess the big question is the sustainability of that over the longer term, and that's something that's a question I don't think anybody can answer at this point, but it's certainly looking better.
I think that's a big issue, that issue of discipline, and anybody who's bought a gym membership on the 1st of January will know. Will the market sustain that pressure and maintain that momentum? I think if you step back and look at the macroeconomic issues, there's still a lot of surplus capital, there's still low interest rates, and that will continue to make insurance and reinsurance potentially an attractive option for third-party capital, for capital in general. And so the big question is whether that discipline will hold, or whether those macroeconomic issues will continue to force irrational competition within the sector.
Yeah, I think that in general there is agreement that yes, there has been some improvement. Now, whether that's enough, probably not. Whether it's in the right pockets, I think that in general, say on average, there is some improvement, but there is still going to be some bit more refinement on that. Now, pressures definitely on the primary side. There is a bit more discipline. At least, say, big players in the market are announcing some, say, actions to try to correct the problems in the market. But there is as well pressure from the retrocession side. See some contraction and some weighting in terms of the availability of third-party capital, which has been dominating that sector.
So in reference to Carlos's comment about the fundamental improvement, definitely it's occurring, but even though there's excess supply in the market, what we are seeing is that some of the capacity suppliers are actually pulling capacity back, especially in Florida. So they are acknowledging that there's a fundamental change in risk. The pricing has improved, but the real question is whether or not that pricing is sufficient to cover the true changing dynamic of risk. So I think that that's a healthy thing for the market and should help further the momentum that's occurred thus far.
So if we could explore the third-party capital issue a little bit more, in light of the losses from recent years and the trapped capital issue, has the third-party capital changed its views of the market?
Well, again, I think that they definitely have. I think that there were a number of surprises that occurred in 2017 and in 18. And I think a lot of it is around, the trapped collateral or the tail that's associated with events. I think most investors, recognize that there's risk, And when they priced the risk, they thought that once the loss occurred, that the settlement period would be relatively quick. There wouldn't be the degree of social inflation that has actually occurred, and that the tail would be much longer. So what we're seeing is 2017, 2018, and there's still about 20% of the alternative capital is trapped, for collateral reasons. And when the risk was priced, there was no acknowledgement of that degree of tail. So there's in essence assets that are sitting idle that can't be redeployed to earn additional return, and that was never factored into the original pricing equation. So investors aren't happy with the level of return, and therefore feel that they need to get a higher margin in order to make the product viable from their perspective.
But I think that from an investor's point of view, the sector is still attractive, especially because of the low interest rates, because of the lack of opportunities in other sectors. What is happening is that they are taking a pause, they are assessing the opportunities more carefully, and we will expect some flight to quality as well. Mm-hmm. So investors are going to be much more selective on where they are deploying that capital.
Absolutely. And yeah, absolutely. I think that's a very true statement, and we're already seeing some level of consolidation. Certain fund managers the funds under management have declined. Other asset managers, the funds under management have increased because they have performed relatively well, relative to that particular peer group.
I think the other key trend that we're seeing now is a closer alignment between that alternative capital and traditional capital, where historically they were seen as almost completely separate pools of capital. And I think if you go back sort of 4 or 5 years ago, there was a lot of talk about alternative capital being a major threat to the traditional market and to traditional capital providers. And particularly at Monte Carlo, there were talks about Armageddon for the traditional capital providers. We've seen now that much closer alignment. We've seen you just don't hear the talk of that threat any longer. And I think what we're seeing is a transition to alternative capital just being another form of capital within the reinsurance space, and a much closer alignment. And I wouldn't go so far as predicting, but at some point in the future, maybe the phrase alternative capital will cease to exist.
Is that part of what you would consider the natural evolution of the market?
Well, I think absolutely. I think the market always has evolved. I mean, so it's probably, alternative capital has really existed for about 10 years. It certainly has grown in size and in scope. But, quite honestly, when you think about it, the first alternative capital was the first users of that capital were the traditional players. Swiss Re was a leader, Renaissance Re was a leader. Then it morphed into an independent source of capacity to the market, where investors used fund managers to directly, in some form, bypass the reinsurers in order to access the risk. But now it's gone back where the reinsurers, the traditional reinsurers, either are partnering with or are utilizing it for retrocessional capacity. So the alignment is definitely greater today than it was 5 years ago. There's no question about it.
I think actually you could wind the clock back even further and say actually the first form of alternative capital were the Bermudan startups. Yeah. And what's happened now is just the form of that capital. When market opportunities exist, capital has now found a much quicker way to get into the marketplace rather than going through the traditional startup route. So we see it as an alternative capital form. It's just an variation of the same.
Evolution.
Exactly.
Yeah.
If I can follow up on something, Bob, you said with retrocession coverage. There was a time when the big reinsurers did not buy retro coverage. They kind of viewed it as supporting a competitor. What changed that view?
I think price, quite honestly, efficiency, capital efficiency. So you're absolutely right. I mean, I know, the huge balance sheets, Swiss, Munich, Berkshire Hathaway, they really didn't feel that they had the need to utilize retro, and in fact, they were major sources of retrocessional capacity. But once the alternative capital came into the market and was able to, to deploy that capital in a more efficient manner, more cost-effective manner, that kind of displaced those players out of the retro market. And gradually, over time, traditional players, found that that was an optimum way to basically allow them to continue to provide, increasing lines of cover to their clients, but pass it through to this cheaper form of capital. So, and again, that's part of this evolution that we were talking about, in your previous question. And I think that that's going to continue to be the case. I mean, it depends on the market dynamics and the opportunity in terms of, and the pricing in terms of, where that risk ultimately comes to reside. Does it reside on a traditional balance sheet, or does it go to an alternative form of capital? But again, I think that the reinsurers are going to kind of be, I'm going to use the word threshold of sourcing the risk. Listen, they have the distribution and the relationships with clients. I think we talked about flight to quality. I think that given some of the issues around alternative capital, I think a lot of insurance cedents are looking to do business with a traditionally rated balance sheet because there's a lot of certainty around that, and then they let the reinsurer basically source the alternative capital to back the risk.
And you mentioned capital efficiency. I think that's definitely an important point, especially with the largest reinsurers. Say that has been a way of trying to stabilize capital requirements and effectively improve ROEs as well.
So have you heard much about emerging risks at the conference?
Well, emerging risks, there are always emerging risks. There are risks out there, quite frankly, that we haven't contemplated yet. But certainly in terms of some of the new opportunities, I guess that cyber seems to be the one that seems to be most talked about, and maybe the one that the industry is grappling with. I mean, there's still a lot of uncertainty around how to measure your exposure or your accumulations to that particular type of risk. And then also the pricing, it's still very, very new. It's being provided as cover and it's being reinsured, but I think that everybody acknowledges that there's a lot of uncertainty just because the modeling around it is in its very early stages. So I think it's being covered in a very cautious way. I think people are trying to control it through limits offered and then the aggregation of those limits. Then there's U.S. mortgage. I think that has evolved very, very quickly. Again, it's a pretty well understood risk, and right now the margins are extremely favorable. But I think also reinsurers acknowledge that that can change, and it can change, fairly quickly. So I think that they, while they're in that particular aspect of the business today, they have, in essence, I'll call it an exit strategy, how to basically get out quickly in order to minimize a deterioration should it occur. Terror, I mean, that's been around, that's been a product for quite a few years, really, following 9/11. Again, I think that, controlling aggregate accumulations is paramount, but it's certainly, I think, in demand. And with the potential expiration of TRIA over the next year or so, there's a potential opportunity, greater opportunity there for reinsurers to offer some form of capital or capacity relief, should that U.S. backstop, either be downsized or I doubt it will be discontinued completely, but should it disappear. So so there are a lot of opportunities on the horizon. Everybody talks about the insurance gap. I mean, that's certainly, I think the market has really done a rather poor job, quite frankly, in trying to address that. But I think that there are bigger issues too, and I think that things are get addressed in order of magnitude.
With some of those risks, I think one of the big challenges, not just for insurers and reinsurers, especially for emerging risks like cyber and terrorism, is first of all that they are evolving, and second is modeling capabilities. Yeah, so I think that there is still we are still at early stages of trying to get to reliable results, especially if we're thinking about, say, opportunities for alternative capital. Yeah. So without, standard modeling results that the market really relies on, that's when.
Yeah, I mean, the reinsurers can play a critical role in aggregating that risk and providing, putting some metrics around it in order to pass it to the capital markets. I mean, that's certainly a future potential, and seems to make the most sense because, I mean, there's trillions of dollars of alternative capacity that could, in essence, be, if properly packaged, could be attracted to that particular space.
One other perennial issue that's come up during the course of conversations this year has been the subject of intangible assets and potential insurance of that. And the statistic that 86% of the value of the S&P 500 is based on intangible assets, which is largely uninsured, shows the potential for probably a capital market solution would be required to address the magnitude of the risks that exist there. But it's something that, again, historically, the insurance industry has not done a great job of finding solutions to insure intangible assets.
That would be a major shift for the industry, wouldn't it, to go from insuring tangible assets to intangible assets? Is that something the industry is really grappling with?
Some thought's been given to it, but I think it is such a difficult subject. And I think if there were an easy solutions, then they would start to emerge, particularly during a period that we've had of a soft market of excess capacity and excess capital. Then ways to deploying that capital get invented quite quickly. So the fact that we haven't found an easy solution for intangible assets suggests that it may be a long path before we get there. But if you look at that evolution of the industry over the years, some of the products that are now insured and services that are offered today by the insurance sector probably couldn't have been imagined 10 or 20 years ago.
Great. Well, thank you so much for speaking with us today.
Thank you.
Bob, Greg, and Carlos.
Thank you, Meg.
For AM Best TV in Monte Carlo, I'm Meg Green.